Have you ever wondered how SIP investments work? Let's dive into the world of SIPs, or systematic investment plans. They're a popular method of investing in mutual funds, offering a structured and disciplined approach to investing. Imagine you're setting up a regular savings plan, but instead of stashing away your money in a piggy bank or a simple savings account, you're putting it into a mutual fund scheme. With SIPs, you can do just that. You decide on a fixed amount that you're comfortable with and invest that amount at regular intervals. It could be monthly, quarterly, or even annually. This system of regular, disciplined investing helps to build wealth over the long term and can be a great way to get started with mutual funds. It's as simple as setting and forgetting, with the added bonus of potential returns from the mutual fund scheme. So, SIP is a simple and convenient way of investing money in mutual funds, but how does it actually work? To understand how SIP works, think of it as a disciplined approach towards investments. It's like clockwork, steady and systematic. The way it operates is straightforward and designed for ease. Here's how it works. Firstly, you decide on a fixed amount that you want to invest every month. This could be as low as a few hundred rupees or as high as several thousand. The choice is entirely up to you and what you're comfortable with. This predetermined amount is then automatically deducted from your bank account each month. You don't have to worry about making manual transactions or missing out on any investment opportunities. It's all taken care of for you. The deducted money is then invested in a mutual fund of your choice. Now, mutual funds are essentially a pool of funds collected from various investors, which are then invested in a diversified portfolio of stocks, bonds, or other assets. The objective is to generate returns over time. Here's where it gets interesting. The number of units you get in the mutual fund is dependent on the market value or net asset value, NAV, of the fund on that particular day. When the NAV is low, you get more units for your money. Conversely, when the NAV is high, you get fewer units. This mechanism is known as rupee cost averaging. It's a strategic approach that helps mitigate the risks associated with market volatility. You're not trying to time the market or predict the highs and lows. Instead, you are investing a fixed amount regularly, irrespective of market conditions. This way, you buy more units when the price is low and fewer units when the price is high. Over time, this can potentially lead to higher returns. It's a simple yet effective investment strategy that leverages the power of compounding and the principle of regular saving. Thus, you buy more units when the price is low and fewer units when the price is high, which can potentially lead to higher returns. Now that we know how SIP works, why should we consider it as an investment option? Well, the significance of SIP investment lies in its three key benefits. Firstly, SIP promotes disciplined saving. It's like a fitness routine for your finances. You commit to investing a fixed amount every month, similar to how you'd commit to a gym schedule. Over time, this discipline can lead to substantial savings. Secondly, SIP employs a strategy known as rupee cost averaging. Picture this. When the market is low, your fixed monthly investment buys more units of a fund, and when the market is high, it buys fewer units. This averages out the cost of your investment over time, protecting you from market volatility. Lastly, SIP harnesses the power of compounding. Just as a snowball grows larger as it rolls down a hill, the returns on your investment are reinvested to generate their own returns, leading to exponential growth over the long term. These features make SIP a powerful tool for long-term wealth creation. Scene script. Like any investment, SIP, or systematic investment plan, has its pros and cons. Let's explore these to give you a clearer picture of what SIP investment entails. On the plus side, one of the biggest advantages of SIP investment is that it instills a discipline of regular saving and investing. It's like the old saying, a drop of water makes a mighty ocean. Monthly contributions, however small, can accumulate into a substantial sum over time. Another pro of SIP investment is the ease of investment. You don't need to be a market wizard or have a large chunk of money to start investing. You can start with a small amount, and gradually increase your investment as your income grows. This makes SIPs accessible to everyone, from college students to retirees. Flexibility is another strength of SIPs. You're not tied down to a fixed investment amount. You can increase or decrease your SIP amount as per your financial situation. Also, most mutual fund companies allow you to stop your SIPs without any penalty, giving you total control over your investment. However, SIPs do come with their share of cons. One of the main drawbacks is the market risk associated with it. SIPs, especially those investing in equity mutual funds, are subject to market volatility. The returns are not guaranteed and depend on the performance of the market. Let's take a look at some recent examples from the Indian stock market to understand the real-world impact of SIP investments. Consider the story of Mr. Sharma, a regular office worker who started investing in SIPs in 2010. Over the course of 13 years, by investing just a few thousand rupees every month, he was able to build a considerable corpus thanks to the power of compounding and the steady growth of the Indian economy. Then there's Ms. Patel, who began investing in SIPs in 2012. Despite the market's ups and downs, her disciplined approach to investing and her unwavering faith in her chosen funds have resulted in a robust portfolio that's growing every day. These are not isolated examples. Thousands of Indians are reaping the benefits of SIP investments, building wealth slowly but surely and securing their financial futures. These examples show the potential of SIP investments when done wisely and consistently. In conclusion, SIP investment can be a powerful tool for wealth creation if used wisely. We've looked at how SIPs work, their significance in helping investors spread risk and accumulate wealth over time, and the pros and cons associated with them. We've also seen real-life examples from the Indian stock market that illustrate these points. Whether you are a beginner or an experienced investor, understanding SIP can help you make better investment decisions. Remember, the key to successful investing is discipline, patience, and consistency.